Hello, everyone. Thank you very much for joining us for the NASDAQ Dorsey Wright Wednesday podcast on this Wednesday, August 26th. My name is Ian Saunders, and joining us here today is Will Gibson. And Will, we're coming in this week to another pretty strong week, at least on the domestic equity side of things here. Coming in at the beginning of this week with major market domestic equity indices printing new all-time highs and continuing that trend throughout the week. Coming in here on Wednesday, looking at the default point and figure chart of the S&P 500 shows an additional few X's that are going to be printed there. But if you widen that chart scale out to the 20-point per box size chart, which has been the chart that we have really tended to be following over the past several weeks with this market decline and then subsequent rally, given that it has a fair amount of consistent support levels as well as those consistent signals that you want to look for on your chart scales. So on that 20-point chart, noting that we are still on 3 consecutive buy signals and sitting up on a little bit of a stem, but printing an additional X, at least at the time of this recording, with trading here on Wednesday up at that 3460 level, which is marking another all-time high for that big major benchmark there for the domestic equity side of things. So that 3460 point on the default chart, your initial support, on the 20-point chart, your initial support would first be coming in that 3220 to 3200 kind of range, where we saw some highs for the S&P 500 there earlier this year. And then you're looking at further support down at 3140 to 3120 area. But again, continuing to climb, printing a new all-time high, but sitting up more towards the top end of its trading band here, certainly. But this continuation, this upwards continuation we've seen for most areas across the domestic equity space over the past couple of weeks has led to some major indicator changes, most specifically with movement yesterday leading to the domestic equities asset class in the dynamic asset level investing tool, or the Dolly page, as we call it, moving back into the number one position, moving ahead of fixed income there by one signal. So it's important to note there, domestic equities moving into the top spot with 229 buy signals. Fixed income now with 228 buy signals. Those two asset classes have gotten within one buy signal of each other with the update to this indicator there yesterday morning. So fixed income was sitting at 229. Domestic equities was sitting at 228. They've now flipped. And so domestic equities is in the top ranking with the most buy signals. Important to note that we do want to wait for a 5-signal differential for domestic equities, so to be truly cemented in that number one ranking. We'll wait for 5 signals before we change the allocations in any of the Dolly strategies that we have here on the site. So if you're following any of those strategies, be sure to keep that in mind. We are still looking for that 5-signal differential, but nonetheless, it is strong to see domestic equities back in the top ranking there. It maintained the top ranking for about 89% of the 2010 to 2020 decade there. And so having it move back into the top spot after dropping to fourth from number one earlier this year is definitely a good sign to see that further follow through for the broader domestic equity space. And things we're continuing to monitor, again, that 5-signal differential. Some of the signals that you are looking for representatives to keep an eye on to track some of that further movement. One in particular would be the chart of the S&P 500 compared against money market on an RS chart on a 3.25 scale. You can see that this chart provides a pretty good picture of the move that we saw. And when you broadly look at stocks against cash or stocks against bonds, and in a lot of cases as well, saw this chart move down, give a sell signal there in March, climb back higher, and one column of X's all the way back up to currently still be sitting at a double top formation that it reached earlier this month. By nature of the movement we've seen, this is an RS calculation, so it is flexible, but we need to have domestic equities get back into above really the 3490 range, 3495-ish, in order for this chart to probably go back to a buy signal. So something to continue to keep an eye on there. And again, that is something that will be flexible given that relative strength relationship. But definitely a big column of X's upward that's sitting at that double top. And the big column of X's we've seen on the broader chart of the index itself has, as I mentioned, led it to be in more overextended territory, sitting up towards the top of its trading band there, Will.
Yeah, that's right, Ian. Looking at the S&P 500 chart, we saw it at the top of its trading band. No shortage of price appreciation, really, for the large cap domestic equity benchmark as of lately. And to your point, kind of building on that, or maybe a bit more thematically, a discussion about an overextended nature of the market, an overbought posture of the market, and just to maybe add a few tools or collateral or talking points around that, some indicators that we will look to reference. One, to begin, is going to be the bullish percent for the New York Stock Exchange. If you're unfamiliar, it's a participation indicator that is telling us the percentage of stocks in the New York Stock Exchange that are currently on point and figure buy signals. In relation to what we're talking about right now, we're really looking for high levels, and we're consider a high level generally maybe around that 70% threshold or above that. So again, a recent reading is just under 68%. So again, not in that elevated frothy territory just yet, but we are getting close in respect to that indicator. Again, a lot of participation that we're seeing. Another one that we'll note is going to be the NYSE high-low, which is the New York Stock Exchange high-low indicator. It is measuring the percentage of stocks hitting new 52-week highs relative to those hitting new highs and lows. And note that's smoothed over a 10-day moving average. So again, point with this indicator is that it was in high field position above that 90% threshold and is currently at about 86% and within 1% of reversing. So again, we're seeing some near-term indicators pushing into high field position, bullish percent, high, low. You have the S&P 500 at the top of its trading band. If you follow the implied momentum bell curve, again, looking at that S&P 500 universe, using option volatility. And again, the point being here is that we're seeing a rightward skew. So again, a moderate suggestion that we're seeing an overbought posture, but again, nothing material yet, nothing to say run for the hills, just some talking points to see that there is evidence that we're seeing a trend in that direction. Now, nonetheless, that's not to be ominous, because in fact, looking elsewhere on the platform, we've seen that strength manifest in a high equity core percentile rank. And that equity core percentile rank, again, keeping with that S&P 500 index funds group on the asset class group scores page, is just under 95% now. So again, out of all 135 plus groups we're tracking on the system, the S&P 500 core, or that S&P 500 group of funds, is currently, we'll say, stronger than almost 95%.
Yeah, absolutely there, Will. I mean, and that speaks to a lot of the strength that we've seen. I mean, the S&P 500 index funds group has been one of the higher domestic equity areas, really. I mean, even throughout the market decline. We saw this. I mean, it's for those that track that U.S. equity core percent rank, and some that implement it as a cash trigger like we do for some of the strategies we have on the platform. I mean, that cash trigger is not going to come into play unless that indicator gets down beneath 40%. We saw it get down in the 50s, but not quite down low enough to dictate a more defensive posture, and then has risen back up pretty sharply here. I mean, we've seen over the past several years that it has maintained a position above 90 for prolonged periods of time, right? And I mean, we're moving back up above 94% now, 94.37, as Will said there, with that average group score for the S&P 500 index funds group sitting at a 4.74. Which, I mean, so we've seen the U.S. equity core percent rank from a straight percentile rank perspective be significantly higher. The group currently sits in 8th. It's been number 1 before. But that 4.74 average score is actually the highest score print for that group throughout the history of its score, going all the way back to the 2003 timeframe. So we noticed that it's previously gotten new score highs in October of 2018, and then again in February of this year. Were the last 2 times that it reached that score high. So not necessarily the best times to be jumping into the market at those particular times, would be one thing to kind of to note immediately when looking at this page. But again, like you said, we have to take everything in perspective, right? And when we're looking at that U.S. equity core percent rank, we've seen that be higher. We've seen it be higher even in this market rally. That U.S. equity core percent rank climbed above 95% in June of this year before normalizing a little bit. And so one thing to note is that October 2018 timeframe, as well as the February timeframe, saw percentile rank readings in the 99th percentile for that S&P 500 index funds group. And so while we see an all-time high score print, there's still stuff scoring higher. I mean, this just really speaks to the breadth that we see going on across the market, with both on the equity side, looking at mid-cap growth, aggressive growth, technology, internet, large cap growth, all scoring above the S&P 500 index funds group, but then also across other areas. I mean, we're looking at almost 50 groups, 49 groups with an average score above 4.0. That's not something you see all that often, and it's not something that's just specifically pertaining to the equity space there, Will.
Yeah, Ian, that's right. And one point I'll tack on to that equity discussion is that to your point, it's been higher and it can stay high for extended amounts of time, like some of those near-term indicators, like we just talked about a bit ago, the bullish percent, the high low. Again, those have been known to stay in high territory for a while. We know the market can have an upward bias or does have an upward bias. So really, picking those tops can be extremely difficult, which is why we're trying to look at the weight of the evidence and just have things to monitor or tools that we know we can go to when or if we see the change in tide, again, from the near term. But in terms of other places, we're seeing some increased participation, broad participation. Ian touched on the equity markets and myself as well. Another area is commodities. As of lately, we've seen a broadening of groups that are participating in the rally. Began with kind of the gold, silver names drawing a lot of attention. As of lately, you've seen some softs pick up steam as well. As of lately, natural gas, crude oil. Note there's some thematic tailwinds behind that. But nonetheless, the group itself is bumping up against that 3.0 average score line on the asset class group scores page. So again, that 3.0 score line is notable because that's going to win. Really, you're going to enter technically strong, again, generally technically strong, acceptable territory. So that's notable for the commodities group. And those individual names, your precious metals, are cooling off a bit near the top, and then you're getting the broader basket moving higher. So a lot of strength there as well.
Yeah, absolutely. And I mean, in the commodity space, and then we also see a fair amount of fixed income representation at the top end as well. I mean, convertible bonds being one area moved above that 5.0 score threshold for the first time there as well. So, I mean, seeing domestic equity moving to all-time highs, some of these fixed income related areas, especially those that are more correlated to the equity growth, your convertible bonds, some of your corporate bonds in here as well that are all scoring and at higher positioning. I mean, really, again, speaking to that breadth. And another route that we were coming at in terms of looking ahead, right? Okay, so we're at this point now. It's almost everything doing well, right? What are we going to look at over the next couple months? Well, we also happen to be heading towards an election here at the beginning of November. And so we had a bit in yesterday's Research Daily Equity report that was looking at historical returns from major market representatives, looking at stocks, gold and silver, and then aggregate bond index during historical election period. So, I mean, with coming in with the Democratic convention wrapping up and the Republican convention going on right now, definitely in the heat of the election cycle, and then looking historically at other election cycles and how those particular areas performed, we've seen that if you exclude the 2008 timeframe from those tests, which obviously that 2-month period in 2008 led to some pretty significant drawdowns across the board and pretty much everything but bonds. So if you exclude that time period, you're looking at a 2-month period that doesn't have as big of an effect as you might think on the equity space. You're still looking at an average return of exceeding 1% during the 2-month period leading up to November. So looking at essentially August 31st through October 31st of each election cycle there. Still an average return exceeding 1%. Bonds still do pretty well also. They're the best performing area on average during that time frame at a gain of 1.7%. But each of the places that we examined, the Dow Jones, the S&P, the NASDAQ Composite, Gold, Silver, and then the Aggregate Bond Index were all up on average during that 2-month time frame. So we're heading into that 2-month time frame now with everything certainly they're doing well. We certainly be a place to keep an eye out for to see which of those areas may or may not continue that trend over the next 2 months as we head towards wrapping up the month of August here. But definitely one point to note there, and a pretty interesting article. If you do sign up there for the daily research, definitely a good point to come in and take a look at there. That was in the report from Tuesday. So with that there, Will, I think we touched on most of what we were looking to cover today.
Yeah, Ian, I would say so. And in going out, I have an unprecedented question for you that we didn't plan for. We are hitting a high number of podcasts on the Dorsey Wright series. If you had to take a guess, where are we at right now?
That's a good question. Running total. Are we north of 700?
Oh, we are certainly north of 700. 773 today. So
wow,
momentous occasion, just like the market, pushing higher. So I've enjoyed it. Thanks for having me on.
Perfect. Yeah, and thank you for joining us here, Will. And thank you very much for everyone listening in here this week on podcast 773. We will be sure to circle back next week and hope to see you next week for number 774.